Stocks trade in the green as we near the close of 2022 with very modest returns that are still ahead of most global markets. Metals and utilities lead the gains this session, while financials and FMCG lag.
Reliance Retail enters the packaged confectionery segment with the acquisition of Lotus Chocolates, acquires 51% stake for 74 crore rupees, also makes an open offer for an additional 26% stake in the company.
Craftsman Auto will acquire auto component manufacturer Dr. Axion for a sum of 375 crore rupees. The stock up by 8%.
Brokerage house Equirus issues a bullish call on Go Fashion, sets a target price of nearly 1,500 rupees a share, citing an improved margin profile and robust cash flow generation.
It's a subdued listing for electronic goods maker Elin Electronics. The stock debuts at a 2% discount to its issue price, falls further, now down by 5%.
Good morning, you're tuned into Chartbusters on CNBC-TV18. I'm Sonal Bhutra and with me is Manglam Malu, the last Chartbusters of 2022, last of many things actually. But of course, it's been a phenomenal year, and today as well, we are looking at what the markets are doing. That has to go on, and it looks like a good day. But of course, lower volumes today.
Lower volumes today, and we speak a lot about the last of this, last of that. The interesting part is Monday, 2 days from here, we'll all still be here, and then we'll say it's the first of a new year. So let's hope that, the next year, as we always do towards the end of the year, is much better for the markets as well, though this year wasn't particularly bad. So let's start with a quick technical check on the markets. Manas Jaiswal. Manas, today, obviously, volumes are low. Your thoughts for where we go from here, and more importantly, an outlook, if you can, for 2023.
Good morning, Manglam. So I think the trend is definitely bullish, and Nifty is facing some resistance on higher levels because today in the morning Nifty has tested its 20-day moving average. Now we have seen some profit booking, but again, if you're talking about the trend, I believe that the trend is quite positive. And if you can hold the position for next 2 to 3 trading sessions, then definitely even at current levels you can take a chance, take a long position here. The stop loss should be around 18,100. However, I feel that on the upside, this time Nifty can break its 20-day moving average, and it can test 18,425 or maybe 18,450 in next 2 to 3 trading sessions. So I think even at current levels, one can definitely take a long position. Even Bank Nifty is looking strong on the charts. See, Bank Nifty has some resistance near 43,500, but looking at the charts, I think this time it can break 43,500. And it can test 44,000 very soon. So here also you can take a long position.
Manas, then when you're talking about taking long positions on the indices, what about individual technical picks for you?
So good morning. See, I think first one is a buy call on Titan, because I think just 2 days back we saw a breakout. Yesterday we saw some profit booking, but again today the rally has already resumed. The stock has broken the resistance of 25.90. So take a long call in Titan at current levels. Keep your stop loss below 25.64. And on the upside, stock has potential to test 26.75. And second is a buy call on Nalco, because most of the metal counters are looking strong. Nalco has broken its 200-day moving average today with great volumes. So take a long position here. Also keep your stop loss below 79.90. And here the target would be around 86 rupees.
All right, Manas, thanks a lot for that. Call on Nalco Metals is definitely the pack of today's trading session, or the pack that is doing well, and a call on Titan. Titan, of course, we've been highlighting as some positions being built on that counter ahead of their pre-quarter update as well. Just before we let you go, Manas, do you have a view on any of the mid-cap IT stocks? I mean, they're doing extremely well this morning as well.
Yeah. So I think one can take a look on Mphasis, because Mphasis has taken support near 1900. I think in two times in last 15-20 trading sessions. And now since stock has broken its 20-day moving average, it has already regained 20-day moving average. I think stock can test 2050. So for a small move here, definitely one can take a chance, take a long position here. Stop loss should be around 1940 and target would be around 2050.
Hey, all right, Manas, thank you so much for joining us. Well, that's a technical outlook on the markets. It's time to shift focus to our special segment where we'll get you a few ideas for profit from Money Control Pro. Nitin Agrawal of moneycontrol.com joins us to talk about a stock that he's tracking closely. Nitin.
So the company that I have chosen is ZF Commercial Vehicle, an auto ancillary company. First, let me touch upon its last quarter performance. Though the top line remained flat on a YY and Q&Q basis, its EBITDA margin expanded by around 217.8 basis points on a YY basis. The rich product mix coupled with the favorable raw material prices helped the company to expand its product, its EBITDA margin. Now coming to the factors that make us bullish on the stock. First, the company had a very wide product range and its quality product, and on the back of that, the company has been able to gain the leadership position in the market. Secondly, the ZF commercial vehicle continuously been investing in the technological innovation, and it is one of the rare auto ancillary company which has got bargaining power with the auto original equipment manufacturer. This is primarily on the back of the kind of the product quality that they provide. Thirdly, the industry outlook for the company is very, very positive. The fortunes of this company is directly linked to the commercial vehicle segment, and as we have been witnessing that the commercial vehicle segment is the demand for the commercial vehicle segment is moving north, and on the back of the increased focus on the infrastructure, mining, and construction activities, we believe the company is in the sweet spot. And the company also sees a very good opportunity from the bus segment, primarily on the back of the reopening of the school colleges buses. And lastly, the company currently trades at around 35.2 times FY24 projected earnings, which we believe is very reasonable for a company like ZFCV. And hence, we advise investors to accumulate this stock on a staggered manner.
All right, Nitin, thanks a lot for that. That's about ZF Steerings. We slip into a short break. On the other side, we'll have the management of Jindal Worldwide joining in to discuss trends in the textile sector, how the festive season domestically and, more importantly, exports have been. Welcome back. The mid-cap index is doing extremely well. We have 5 stocks advancing for everyone, which is declining. The mid-cap index at an index level is up about 1% as we speak. Let's talk about the textile sector. The brokerage house MK has written a note indicating that most textile companies currently are operating at low utilization levels. This is due to subdued international demand and high domestic cotton prices. The note also indicates that the China +1 PLI schemes as well as free trade agreements will boost growth in the sector going forward. We've been talking about these macros. Let's get micro. We have Gaurav Davda of Jindal Worldwide joining in. Gaurav, that makes the 3 of us who are working on the last day of this year. But though your background looks like you are working from home, so good on you there. Everyone's worried about the way international demand is and domestic cotton prices at the higher levels. I mean, could you give us a sense of how exports are looking for you so far and what utilization are you functioning at?
Firstly, thanks for having me on and wishing everyone a very happy new year. I think, yes, Q2 was a bit rough, but we've seen that raw material prices have actually normalized. Exports have picked up. And I heard you mention something on China +1. I think that's a very real thing in our world today. And this whole start-stop situation of COVID, as far as China is concerned, is really deterring global buyers from actually, having a very, very heavy reliance on China for their, supply. And they are definitely looking at alternative options, with us as in India being, top of the heap as far as they're concerned.
Okay. Gaurav, to be honest, I did not expect you to be at home or be in Bombay for that matter. I really thought you'd be out somewhere partying since it's the New Year's. But as Manglam said, that it makes 3 of us who are actually working on the last day of this year as well. Be that as it may, you are saying that yes, demand is looking better after a rough Q2. What is the general sense as far as the ground reality is concerned? Do you think this demand impact that we are seeing will last for longer, or will it make a comeback very soon? Because if we talk about home textiles division as well, across players that we have spoken to, they did say that export demand, at least here, is seeing a rapid fall. What is your take here? And generally exports, 19% of your revenues, how much can you grow it by, say, in FY24?
So admittedly, I must say I'm actually not in the country. I'm on holiday in Singapore. So you got that one right. But coming to your question on raw material prices as well as demand, I think it's very clear we did see a slowdown in demand in exports, in the last quarter. But that was also because there was a big violence in the movement of the raw material prices, and buyers were simply trying to catch a falling knife as far as the raw material prices were concerned to get the best deal. Now that things have normalized, I think they are back in the market. Planning for 2023 is very strong. Exports did take a bit of a beating in Q2, but we are seeing both domestic and export coming up very well. As far as export contribution to total revenue is concerned, from 19%, I think we should go slightly higher to about 22-23% come FY23-24. And I think we're seeing good export orders even for Q4.
Right. You spoke about China Plus One and India being a beneficiary of that. Over the last few years, the textile sector in India hasn't benefited as much from the China Plus One or people diversifying their supply chain trends. I mean, a country as small as Bangladesh has, from right under our nose, taken away a fair amount of market share. This even as we saw the TPP break and all of that. So what do you think is different this time that India will benefit as against the other nearby countries?
I think that the sheer size of the capacity that exists in India, and with global buyers looking to consolidate their back-end supply chain, I think we have definitely benefited. We have chipped away at China's market share in the global supply chain over the last few years. Yes, it's a very phased approach that is happening. China even today accounts for about 50 to 60%, maybe more of the global supply chain, and you can't just wish them away. So the fact of the matter remains, we have been chipping away at China's market share. And yes, while other countries have taken some share from their, from the overall pie, I think India, given its existing capacity, size, scale, and labor advantage, I think we'll do significantly better going forward. And I think the market share gains will be for everyone to see going forward.
Could you give us some numbers on the kind of market share gains that we can expect from China coming in? And while things look optimistic, it's also important to put the risks on the table. What do you think could be the bigger risks?
Well, honestly, I think it's very difficult to give market share numbers today. It's very, very challenging because there are so many segments and sub-segments within the overall textile chain, whether it is, in terms of ready-mades, whether it is pure textiles, whether it is, various parts of the whole textile supply chain. And it becomes difficult to give you a kind of market share number there. Sorry, what is the second question?
The risks on the table, can you put them as well? Because, I mean, things are looking optimistic right now, but what happens next?
Well, if China suddenly decides to kind of operate at, suboptimal pricing, just in an effort to gain market share, I think that is a big risk for, countries like India. But besides that, I don't see much of a challenge, given the government's policy-friendly approach, the readiness of the industry, the cleaner and healthier balance sheets, and willingness of banks to lend. I think across the board, we're very well primed for a great 2023 onwards.
Okay, so that is something we'll track. So that's about the textiles division, the interesting foray that you've made, and we've been talking about that in the past couple of conversations as well, is the EV foray. Has the commercial production started here, 10,000 units per month? Is that something that you will continue to see as sales? And what is the capex that you're putting in here?
Well, so on the EV side, we are, I think we'll launch our product sometime in April. The manufacturing facilities are being commissioned as we speak in Ahmedabad. The total capacity that we're installing is about 2 to 2.5 lakh units. We have also finalized 40 experience centers across India. And in fact, are one of the few EV players to actually go to and set up an experience center in Nepal, in Kathmandu. And this is all finalized. I think we will launch our products and you will see them, on the streets sometime in the month of, I think, May or June in 2023.
What could that mean in terms of revenues for you? I mean, in terms of a contribution, of course, it will pale in comparison to the revenues that you make from textiles in the extreme near term. But, I mean, to start things off, do you have any targets there?
Well, as I said, it's still very early to determine that, we will be competitive as far as pricing is concerned in the marketplace. The price range at which various of the other competitors are priced at. And I think we will definitely be very competitive, and we hope to achieve a target of 10,000 units per month on a run rate basis. So, that's something that we should be able to hit anywhere between, let's say, 400 to 600 crores of revenue from our EV business in the near future.
Okay, 400 to 600 crore rupees from the EV business in near future. Gaurav, it was a pleasure speaking with you. Thank you so much for joining us, and wishing you and everyone at the company a very happy new year as well. With that, we'll move on and take a short break and get you more on the markets and stock specific action on the other side. Stay tuned. Welcome back. Still tuned into Chartbusters here on CNBC-TV18. Well, Nifty continues to be in the green. It's the banking index which is seeing some pressure today. So that one is down 45 points. And if we talk about the Nifty pack, we do have some gains coming in for Bajaj Finserv. So that stock is up around 3% ONGC too is higher. Overnight, we did see some buying in the crude oil segment. And that's why that stock is up around 2.5%. But of course, lower volumes in the commodity markets as well. Hindalco also has surged to the day's high. So that stock is up around 2%. Bajaj Fin. So basically, Bajaj Twins are doing well in trade today. In the broader markets, we have Manappuram Finance, which is higher by 5%. There's REC and SAIL too. They are at the highs of the day, so up around 3.5 to 4%. So these stocks are doing really well. PSU banking names, they continue to do well. So we have something like a PNB. There is something like Union Bank as well. Both of them higher in trade today. And from the broader markets, also RBL Bank, that has been an outperformer in last couple of trading sessions. And today as well, it is higher. So this week, RBL Bank is up to 20% in trade. So yes, good gains for RBL Bank. They continue. The stock higher by around 20-odd%. But as we draw to a close on 2022, global inflation and subsequent interest rate hikes by most global central banks was the key highlight for markets all around the globe. Lata wraps up the year. That was.
The year 2022 has entered the record books for the two I's, interest rates and inflation. The United States saw the highest inflation in 40 years in 2022, while the Eurozone is seeing the highest inflation since the EU and the Euro were created. Both regions saw several months of near or over 10% inflation in 2022. Looking back, it's surprising why advanced economy central banks missed the price surge. Since March 2020, the US Fed had expanded its balance sheet from $4 trillion to $8.97 trillion at its peak in March 2022. Likewise, the European Central Bank expanded its money supply from $5 trillion to $10 trillion over the same period. This hugely excessive money supply was chasing fewer goods thanks to COVID dislocations and finally the Russia-Ukraine war, which led to a drastic fall in the supply, especially of wheat and gas, for a while. The Fed was the first to pivot. On November 29, 2021, Jerome Powell, for the first time, dropped the word transitory in his description of inflation. What followed was the fastest ever rate hikes in the history of the United States, Europe, and indeed most countries. The US Fed, starting in March, has raised rates by a cumulative 425 basis points this year to 4.25 to 4.5% by December. The ECB, European Central Bank, wasn't far behind in raising rates. It has raised rates 4 times by a cumulative 250 basis points. The Bank of England raised rates by 325 basis points, divided over 8 hikes, although it began hiking in 2021 itself. 2022's legacy to economic literature was the word pivot. Almost every central bank was caught napping on inflation and had to take a 180-degree change or a pivot from their dovish stance. The US Fed pivoted in November 2021. Like I told you, the latest to pivot is probably the Bank of Japan, which raised its cap on the 10-year yields from 0.25% to 0.5%. Back home too, inflation was a headache, but not quite as ugly as it was in the developed Western economies. It stayed outside or above the mandated 2 to 6% zone in which CPI has to stay. So this forced the RBI to write to the government explaining why the mandate wasn't met. The letter, unfortunately, wasn't made public. Inflation apart, the Indian economy had a good 2022. At likely 6.9% growth rate for 2022, India was one of the fastest growing large economies. Growth was reflected in the robust demand for credit growth, as you can see, 7.5 to 17.5% over the year. The steady rise in GST collections and direct tax collections is another proof. And now these taxes look set to surpass budget targets by a good measure. The worries were the twin deficits. While fiscal deficit at 6.4% for the central government and 2.6% for the states is the known devil, the one that sneaked up was the rise in current account deficit triggered by a fall in exports, thanks to the global slowdown. Of course, crude prices was another reason. The rupee therefore fell around 10% in 2022. Now, if the I words, inflation and interest rates, dominated mindspace in 2022, the R word may dominate 2023. Recession, shallow or deep, is expected to hit the United States and Europe. The IMF forecasts global growth to slow from 6% in 2021 to 3.2% in 2022 and to 2.7% in 2023. At 2.7, it would be the weakest since 2001, except for the global financial crisis and the COVID-19 pandemic years. As a result, India's growth is also seen slipping to around 6% in 2023, but it may still be one of the fastest growing large economies. Now, that's the bright side. The dark side could be continued weakness in rural demand, lethargic private sector capex, and continued high fiscal deficit. Well, I began by saying 2022 is the year of the two I's, inflation and interest rates. 2023 may be the year of R, or recession, harsh or mild. But ultimately, everything depends on the three C's: crude, COVID, and climate.
Interesting story there, Lata, and very well told. You spoke about the I and the R for India in 2023. The only thing I'll be watching out for, India's resilience. With that, we'll wrap up on this edition of Chartbusters. Hope you have a very happy 2023.